Gary, welcome to our Q3 2021 investment review. It's October 5th when we're recording this. How are you?
I'm doing good, Ben. How are you doing?
Good. It's getting colder around here.
Yeah, well, and I've also dried out from being a drowned rat on Saturday. I went to a football game down in Lafayette, Indiana, West Lafayette to be
That's right.
exact, and it rained and it poured during the entire game, and I was soaked to the bone. But I'm sitting here in my living room and it's dry,
And you're
so I'm
dry.
okay.
Did Shelly stay for the whole game?
Shelley was the smart one. She left after the first quarter.
Okay, nice. Nice. That's
I
great.
was not so smart.
No, and it didn't help that our boilers lost. So
That made it even worse.
we'll move on from there. So our um we just ended the third quarter and markets were actually not great. Not the best quarter we've had, but especially September was down. We'll talk about that. But any opening thoughts before we jump into my favorite charts?
Well, things are interesting. As the old saying goes, we live in interesting times, and we certainly are right now.
Absolutely, and we will get to some of those interesting headlines and all sorts of things here in a minute. So let's jump in and just take a look year to date. The chart I think you can see up on your screen is looking at various indices that we invest in. We don't have the exact investments, but these are things you could go buy. This is Vanguard Emerging Markets, Developed Markets, S&P 500 bonds, and gold year-to-date return. So this is total return. So you can see here on the screen, the worst investment so far has been gold, actually, so far this year, which is, I think, a little bit surprising just with inflation where it is, but we'll talk about that a little bit more in a few minutes. Bonds, kind of expected, are negative. They're down, not really earning much, down 1.8% for the year. Best investment has been the S&P 500. Again, continues, a 10-year run here where large cap US stocks have done really well, up almost 16% through the end of September. And then developed markets and emerging markets have underperformed the S&P 500, but have still been positive for the year. So any thoughts as you kind of look at this? Any surprises? Anything jump out to you?
Well, I guess what jumps out at me is the concept that we've preached for 30 plus years is diversification. And when you're properly diversified, you're always going to have something that you own and that you should own that isn't keeping up with the market at any point in time. And right now, it's obvious that's gold. So gold doesn't tend to do as well as a market. When a market is doing very good, it tends to do better, really contra to the market. It is a great market diversifier, and returns for gold over thousands of years have been a very good inflation protector. But in any specific year, gold can be down, and it's down this year. It's dragging down returns a little bit. But from the point in time when Ben first started buying gold, gold has been a very nice investment, has helped to reduce the volatility of the portfolio overall. We still want to own it, but is it down this year? Yep, it is down this year.
Like you said, it's diversification, and we're never going to overweight something that's going to always be up or always be down. It's all about balancing between all the different parts of the portfolio.
Absolutely.
So let's go back to our charts here, and I want to talk a little bit more about the makeup of the market And we've talked about this before a little bit, just the power of the big five. So the big five companies that make up over 25% of the S&P 500 are Facebook, Amazon, Apple, Google, which is Alphabet, and Microsoft are all on here. And you can see this is the last 6 months is what we have on here now. So second and third quarter of last year, or this year, sorry. We've got the S&P 500 is second from the bottom, so 7.73%. But you can see that a lot of that's driven really by the power of these 25% that is leading the way. And where these go, the market goes. Overall, when you look at an index, the underlying companies, the other companies, the 495 smaller companies in the S&P 500 have actually underperformed these big five so far this year and really the last 6 months. And I think it's just something to be very aware of. The headlines are always going to talk about these companies. They're the biggest companies in the world. They move the market. We are intentionally invested to be less in these than just the index. So by having a small cap tilt, by having a little bit of a value tilt, we're intentionally going slightly away from these. So you have a little bit less impact on the portfolio. So far this year, that's actually hurt our clients. It's part of diversification. We're diversifying away from just 5 companies, but we still own them and they've done well. But in the last couple months, last 3 months, so here's the third quarter, this is showing the percent off of the high. And you can see that especially in September, all of these companies really kind of fell off and are all off significantly and off more from the peak than the S&P 500. The S&P 500 is down 5% from its peak, but all of these companies are down. You look at the two at the bottom, Facebook and Amazon, down almost 15% from their peak. That's what the headlines are saying. That's when people, I think, get worried because, oh no, Facebook is down, Amazon is down. What are we going to do? But we're invested closer to that S&P 500 than just these. Do you see anything when you look at this or the previous chart?
You know, these are all companies that have very high valuations based upon price earnings and so on. And they are the favorites of the market, and they'll tend to go up more when the market goes up. They'll tend to drop more as the market goes down, and that's just the way it is. We do have some exposure to them. We should have some exposure to them, but we really don't want to be overweight in these stocks.
Absolutely. So let's move on. You kind of mentioned some valuations and things. So we're going to talk, shift gears a little bit about looking ahead. So this was all what's happened so far, but looking ahead and as we see where the market is now and moving forward. First one we want to start with is just valuations. So I'm going to skip ahead to our Shiller PE chart. So Gary, you want to take a stab at concerns about valuation and Shiller PE and what this is showing?
Well, I mean, I think that is one of the reasons to be concerned about the market is when you look at historical valuations, of which the Shiller PE ratio is one good measure of valuation. We're getting up there, the second highest that we've ever had, even more than the 1920s and the 1960s and so on, everything except 1998 and 99. So that's a reason for some concern. Now, a major qualifier to that is that the Shiller historically doesn't tell you when that valuation is going to get to the point that the market is actually going to have a bear market or anything. You can't tell that from just looking at the Shiller, but that is a concern. There are no question that valuations well, they're not low.
No, they're not. They're not low at all, and it is second highest, as you said. Only time it's been higher is tech bubble, right before the tech bubble burst in the late 90s. And the Shiller PE is just basically a measurement of price earnings over the last 10 years and where things are. Now, one factor to keep in mind, and we've talked about this, is part of what goes into this is interest rates. And so, as you can see, since 1980, U.S. interest rates have dropped and just been on this downward slope. As we kind of all know, it would be great if we could go back and buy bonds at 8%. That'd be nice. But the 10-year Treasury is at 1.5%. And that is a factor into higher valuations. Another way to think about the rate that I think is really important for clients to remember is valuations are high for stocks. Prices are high. But when interest rates are this low, that also means bond prices are high. So it's not just stocks that are high in price. Bonds arguably are the highest they've ever been price-wise, with interest rates as low as they are. And even with this rate, United States is one of the highest, if not the highest, in the developed world. You look at Europe, still in negative territory, still having negative interest rates. Prices can even go lower, or sorry, interest rates can even go lower. Prices can go even higher on bonds. And there's a reason, you would argue, that interest rates or valuations are higher, and it's because interest rates are so much lower as well.
Yeah, historically, low interest rates are definitely better for the stock market. That's certainly something that has helped the market do as well as it has since 2009. My concern about that is that short-term interest rates that are really determined by the Federal Reserve, these are, I will call them, government-induced super low rates. They are not market rates. And I'm really concerned about the fact that because these are government-induced rates, it causes things like malinvestment. If you're thinking about building a new plant and you can borrow at 2% or 3%, that plant looks a heck of a lot better to do it than if we had market rates that, and I don't know what they would be exactly today, but let's say you had to finance that at 5 or 6 or 7%. There's a heck of a lot of investments that look good at 2% that don't look good at all at what would be a real market rate, something certainly well in advance of 1.5%. And so I'm concerned about that and that malinvestment, and we may have moved some investment forward, brought it in from the future that could help to reduce growth rates in the future. You know, nobody knows what's going to happen, but I think given what's going on, that tells me that there's a greater likelihood of lower growth rates in the future, but we're still going to grow, and stocks still will participate in that. But I'm afraid we have borrowed some growth from the future.
I think that's a good point, and it kind of leads us into our next discussion on inflation and money printing and all sorts of things we're going to talk about here in a minute. Even with everything that you said, and I think you and I have talked about this enough to know that we agree, just because there's reasons to be concerned about pulling growth from the future into today, that doesn't mean we have any idea on the timing of when things play out the other direction. And it could be decades still before worst case scenario type of events happen, even if we are concerned about a lot of things that are out there from a macro perspective. That doesn't mean in the next 12 months something is going to happen.
Boy, that's for sure. If we could predict that, we could time the market, and boy, we'd be our next YouTube call here would be coming from my 400-foot yacht moored in Monte Carlo Harbor. But unfortunately, it's not going to be that way.
No, it's
And,
not.
being able to predict the future, there's thousands of people that think that they can. The number of people that can do that time after time after time, after a number of years, we could fit them into a dinghy, a little rowboat there, and we are not one of those people. What we do is react to things as they occur, not attempt to say that a year from now such and such is going to happen, because we don't know. And consistently, there's nobody out there that's really good at that over a number of years. There's plenty of them that can do it once or twice, but that doesn't really help you much.
Well, and before we move on, I think now's as good a time as any. Clients have heard from me a lot about their financial goals and how we invest and so on. I mean, I just want to hear in your words, why do we invest in general? We get so focused on the movements here, but I think it's important to step back and take a big picture look at what's the purpose? Why are we investing for our clients?
Well, it's the first one that you've alluded to and talked to clients about a whole lot is investing is the best way to reach your long-term goals. And the reason that that's true is what we're doing is investing in the miracle of capitalism. And capitalism is really the reason that we have had growth over the last 250 years or so. That if you look at from ancient times up until Adam Smith and capitalism came around here 250 years ago or so, and where it really took hold was the Industrial Revolution in England. It's capitalism that has brought forth all the innovative things from human beings and allowed them to flourish. And those are the things, the inventiveness, human inventiveness, that has allowed the growth in an economic system that is built to really help people flourish and the freedom that they get. That's why we invest, is so that you will be able to reach long-term goals that you have, because we don't have anything in the stock market that you're going to need next year or the year after. And that's something that I think people easily forget, that, what's the market going to do in the next 6 months or whatever? Well, we watch that. We're concerned about that. But what the market does in the next 6 months isn't going to determine whether you're going to reach the long-term goals that you have. And that's why we're in the market. You're not going to reach your long-term goals when you're fighting against both taxes and inflation, when today you can invest in a 10-year treasury and get 1.5%. After inflation and taxes, you've lost money,
right,
with
right.
that investment. And stocks and having the ability to invest in equity, whatever form that is, again, whether that's real estate, stocks, different types of stocks, and so on. That's how you're going to reach your long-term goals.
That's great. And that's a great segue to talk about inflation into our next topic, which is inflation. And thanks for that, Gary. So what I'm going to show here, this is the inflation rates since 1970, and obviously we talk about the 70s and early 80s and how high inflation was. Gary, your first mortgage, I always like this story. Do you remember what the interest rate was and why you were happy about it?
Yeah, this was 1980. I had just moved back to Chicago from St. Louis and was looking for a condo to buy in the city. And when I found the condo, at that time, you could assume a mortgage from the seller. And the current mortgage rates at that time were about 13.25%. And young people listening to this have probably just fell off their chairs saying, is that possible? Yeah, it is. Well, I was extremely happy because I was able to assume the mortgage from the buyer at 11 7/8%. And I was ecstatic that I could do that. And, I certainly wouldn't project that that's going to happen again anytime soon, but it sure can happen.
Right.
It's happened before. And I was paying 11 7/8 and really happy to have it.
That's crazy. That's crazy. I mean, what do you think CD rates were then, and things like that?
Well, I can tell you that the money market rates went up as high as, I'm going to say, 16, 17%.
Wow.
And I actually was unhappy with that. And I was afraid to put a lot of money into my money market fund, which were brand new things. Money markets only came about, as we know them today, only came about, I'm going to say 1977, 78 or so. But interest rates had been on a steady march upward
Mm-hmm.
for 15 years or so. And so even though today that 17, 16% rate looks, wow, you'd want to do everything with that. Well, the year before it was 15%. The year before that it was 13.5, and so on. So at that time, I believed, and everybody believed, okay, well, 17%. Well, next year it's just going to be 18% or 19%. Don't lock it up at an potentially inferior yield of 16 or 17%.
Wow. That's crazy. And all that, we're talking about interest rates, but it's all tied to inflation. If inflation wasn't
Yep.
as high as it was then, you didn't have interest rates at that level. You didn't need interest rates at that level. And inflation and interest rates tend to rise together or fall together over long periods of time. Right now, we're not quite in that spot. The Treasury is 1.5% for the 10-year, and inflation rate as of right now is 5.25%. But over long periods of time, those are tied together. And I think as we look at these charts, and let me pull that back up, when you see the spike in 1980 there of the inflation rate hitting, 15%. I mean, that's crazy to think about what that would be.
Yeah, you could get at that time back 79, 80, you could get a 30-year treasury paying 17.5, 18%. I hate to say it, but I didn't load up on them.
Well, and obviously people didn't load up on them because the only way it was at that rate is it's supply and demand. People didn't demand to buy all that. If they did, the rates would have come down, prices would have gone up. So
Right.
that's crazy. So let's talk about today now. Tell me, Gary, you and I talk a lot about secular inflation and this concern that we're going in an inflationary. This is not just transitory. I think we both kind of agree. It's kind of crazy to think it's just transitory. But tell me, in your mind, what are the big concerns for inflation in the U.S.?
Well, first thing I will say, I am sick and tired of hearing that word transitory. It is so overused that every time I hear it, what little hair I have left on the top of my head goes straight up and I want to punch the TV or the radio.
Wow, Gary's getting violent over here.
Yeah, well, I haven't done it yet.
Okay.
That's a good thing. My wife would be extremely unhappy if she was no longer able to listen to The Bachelor on Tuesday evening. So I'm not about to do that. But there's a lot of discussion about how long inflation is going to go. Here, is it going to be just short term or is it longer term? I am more concerned about longer term. The things that we're seeing out there suggest to me that inflation isn't going to go away in 6 months. I think it's a big question mark how long that it's going to last. Now, in terms of investing, during times of low to moderate inflation, that tends to be fairly good for stocks because it makes it easier for companies to increase prices. So that tends to help earnings and so on. Now, really high inflation, as we got during the late 70s, as we just talked about, that's another matter. High inflation is not good for stocks at all, because when you get to high single digits, or heaven forbid, even into double digits, well, companies can't increase their prices to anything like what inflation is going up. And so it's detrimental to earnings. Over time, it's going to be very detrimental to stock prices. But at this point, we don't see where we're going to be looking at double-digit inflation. It's going up. I don't consider that to be a good thing as rapidly as it has gone up here. But at this point, we still think that moderate inflation is probably a moderately good thing for stocks overall.
Mm-hmm. Yeah, and I think so. Definitely looking historically, inflation. There's some things we can get from the stock market, inflation, and how that's played out. We're also in an unprecedented time, just in terms of the Fed involvement in everything, and the amount of money that's being spent, and the level of budget deficits, and all the above, adding it all together. That every time is different. I know that in investing, kind of it's been known that you should never say this time is different, except for every time is different than the last. And with all that being said, let me share a few charts, just looking at the historical, knowing that we've got to take into account both what happened and what could happen in the future. So why does inflation matter? I guess let's start at the top left of what we have on this screen. Inflation matters because your money is worth less over time. That's what inflation is. It's I would view it, your dollars are worth less is probably a better way to think about it than things cost more. It's the same thing, just flip the argument around, but the devaluation of your money. And so this top left is, when does inflation cut money in half? When is $1 worth 50 cents? If you only have 2% inflation there on the right, it takes 35 years. If you have 5%, which is where we are right now, if we have 5% for 14 years, your money buys half of what it did at the beginning of that time period. So inflation really matters from a spending perspective. It also matters on a return. So what we have down below is looking at a few different time periods that all had different types of inflation. Nominal returns is the returns you see on paper. Inflation is what was the inflation rate, and then real returns is just nominal returns minus inflation. What did you beat inflation by? What are the excess returns over inflation? So you can see that 1970s, which is the 1966 to 1981, which was known as the worst time to retire 1966 historically because of high inflation. Returns actually after inflation for the stock market were negative lost almost 1% a year, 0.9%. So as you said, Gary, inflation that's high, there's the highest inflation on that list, average almost 7% for 16 years. That's a big deal. And it's hard to make up for it. That being said, if you just own bonds during that time period, that did even worse. And you can see on the right, those numbers there, just looking in the chart form on what actually happened on a real return. But with all of it, stocks are still one of the best inflation hedges that we have. They're not perfect. They don't move in lockstep with inflation to keep up with it. But in the long run, if you're a long-term investor, stocks are still going to be one of the better hedges against inflation because you're getting higher returns.
Couldn't agree more.
Great. So let's move to some headlines. There's a lot of headlines right now. And you said before we started recording, you said there's a lot of things going on and there are a lot of reasons to be concerned. And as you said at the very beginning, we live in interesting times. So let's talk about those interesting times. I've got three different kind of headlines here. We've got top right, just South China Sea, some geopolitical risks. On the left, we've got energy inflation and food inflation, just inflation around the world, really picking up. And then, of course, we know the whole Capitol Hill gridlock. Don't even have on here Evergrande listed, but there's a lot of things going on out there. Anything you want to talk about?
Well, what I would say is, number one, sometimes people will talk about, that they want to be more invested when the economy or the stock market is more stable. Well, the stock market is always doing one thing or another, economics and political. There's always something going on, and there's always something to be worried about. And if we went to cash, 100% cash, heaven forbid, or 50% cash when we got worried, well, I'd say we'd probably always be in cash, right? Because there's always something to worry about. And that's not the way to go about investing. And the reason for that is because then you're letting emotions determine how you're going to invest. And with my nearly 35 years of experience as an advisor and my over 50 years investment experience, I know that emotions makes people, and that includes professionals with long-term experience like myself. If I let emotion determine how I'm going to invest, I'm going to want to buy when the market's already high and going higher, because my brother-in-law is telling me about how much money that he's made in the market, and I'm afraid that I haven't done that well, so I better go jump in. And when we go into a bear market, my brother-in-law is telling me about how, oh boy, I got out a long time ago and I'm still in. So what do I want to do when things are really down? I want to sell. Those are exactly the wrong things to be doing at exactly the wrong time. You've all heard about buy low, sell high. Well, you ought to be buying. And that's what you'd be hearing from us when the market has really gone low. When the market is really hitting new highs and everything, that's not the time that you want to be jumping in with both feet into the market. Don't let emotions, and that's one of the things today with the market being up pretty high, and I've read numerous articles written about the fact people getting nervous, and there's plenty to be nervous about. I'm not underestimating that, but to decide, well, let's go sell out a big part of the portfolio, heaven forbid all of it, is not the right move to be making.
Absolutely. And just to piggyback on that, I think what we've got up here is a little chart that made the rounds on Twitter recently. So you may have heard the book Rich Dad Poor Dad by Robert Kawasaki, and he wrote that I feel like around 2000. But he tweeted just last week that there's a giant stock market crash coming in October, and you should go to cash and all this. And I had a few clients actually send me some articles, and it mainstream media picked it up. It was all over CNN and the Wall Street Journal and all sorts of things talking about how he's saying, predicting this crash. This chart, I think, is really good because what you're seeing is the S&P 500 back to 2009 and all the different times that he's actually predicted a crash and said, you need to get out now. And the whole point is, you could look at any year. You could just Google it. What are the headlines for a crash in 2011, 2012, whatever? And you could see all of the headlines and all the things that suggested now's the time to get out of the market. I want to get out. I don't want to be in when things are volatile. But if you had sold and followed this advice, and not to pick on him, but any advice that says now's the time to get out, we can predict the future, we know this crash is coming, you're going to be significantly poorer by trading around the headlines than just staying invested for the long run. And that goes back to what we talked about earlier. There is no money that any of our clients has in the stocks that they need for the next 10 years. That's just a rule that we have. If you are invested in stocks, that money needs to weather through the ups and the downs of the market. And so if you're going to buy a house, if you're going to retire and withdraw money out of the portfolio, if you've got college expenses to pay for, that money shouldn't be invested in stocks if you're going to use it the next decade. The only money invested in stocks is for the long run. And so you can weather through any of these ups and downs in the market because you're able to keep it invested, buy low, rebalance between the diversified assets, and stay invested. And that's the number one factor for success, is just your ability to put emotions to the side and letting the market do its thing.
Couldn't have said it better.
Well, I learned from you. So, so I guess to wrap up, Gary, is there anything we didn't talk about or didn't talk about enough that you want to address, to our clients now?
Well, I'll go back to a positive thing that we talked about. I think it was in our last YouTube get together. I am very positive about things that are happening on the technology front. And beyond just those 5 FANG stocks, and that's one of the reasons why they've done so well, because that's mostly technology. But there are great things well beyond what those 5 companies are doing that I'm very encouraged about. And we were talking about future growth of the economy. I think that's the foundation of the biggest part of the future growth that we are going to have in this country and worldwide, for that matter, is the great technology things that are out there, and we'll be seeing more of them excuse me, over the next decade. Absolutely.
Sorry, there's a siren going off right behind me, but I think there's a lot of reasons that clients are pessimistic and they're worried about the future, but there's a whole lot of positive things that are out there, and technology is one big one. As we look ahead, as you look ahead, and it's easy to be attracted to all the negative headlines, but there's a lot of reasons to be positive as well.
Negative headlines is what sells ratings and sells newspapers and so on and so forth. It isn't necessarily an accurate reflection of everything that's going on in the world. Absolutely. Bad news is easy to sell.
I think that's a good way to end. So, Gary, thanks for being a part of it again this month.
Glad to do it, Ben.